So since our chairperson is going to be a little late for this meeting, I'm going to call the board to order 110 March 26, 2026. We will start with introducing the newest member of our board, Dr. Juliana Aikman, and I'll ask Juliana to just introduce herself briefly to the board.
Hi, Juliana, very nice to meet you. I'm a second. Might put that button right there, so right there. Aha. Hello. I'm Juliana. Very nice to meet everyone. I'm a psychiatrist by training, a public psychiatrist. Spent most of my working life working in public settings, including Medicaid managed care, community settings, and startups devoted to supporting folks on Medicaid. And I'm very excited to have the opportunity to bring some of my experience and the things I've learned along the way to helping the members of MetroPlus.
Thank you. Very excited to have you here with us. Welcome. I know you'll have a lot to contribute together with the other board members. Okay, so we will start with the presentations first until the other board members join us, and then we'll switch to resolutions. So we'll start with KPMG. Neil?
Great. Thank you, everyone, for having us with you today. We are here to present the audit results for the year ending December 31st, 2025. I know you had the materials before the meeting, so I guess my question to the board is, would you like us to give you the highlights, or would you like us to step through all of the slides?
The highlights, please.
Sure. So first and foremost, the financial statements are due on March 31st, and we are in the process of finalizing all of our test work to allow for us to be able to deliver those financial statements to management. And I'd be remiss if I did not say a very big thank you to the MetroPlus team, Dr. Schwartz, Lauren, and Lily for all of their hard work as we've gone through the financial statements. If we could just advance the slides, I believe, right there. Thank you. Within the materials, you will see that the audit opinion we intend to issue is unmodified as it pertains to the statutory accounting principles, which is the basis that MetroPlus prepares their December 31st financials on. Similar to last year and within industry standard, there is a paragraph that talks about the adverse opinion as it pertains to being prepared in accordance with the U.S. generally accepted accounting principles, or GAAP. So that example opinion is in the materials, and we did not identify any corrected or uncorrected misstatements throughout our test work. If we could just turn 2 slides from here to give the board a sense of where we are. We're at like the 10-yard line coming down to the finish line. We received the support for our journal entry testing, and my team is in the process of completing that. And then we are in what I would call the finalization and down-to-date procedures. So there are certain things we will obtain from management prior to issuing the financial statements, the absence of a material weakness letter, and the qualifications letter that are all required under statutory accounting principles. So we will get a signed representation letter from management, and we will finalize any down-to-date procedures with in-house counsel that we need to do. If we could turn to the slide that just talks about the incurred but not paid liability, I think it's like 2 more. Thank you. This is the significant accounting estimate within the financial statements. It is the largest judgment area within the financial statements, and that's where MetroPlus's actuaries, along with outside actuaries, develops what they think the claims payable will be as they look into the future and understand what has occurred throughout the year. We utilize our own KPMG actuary to evaluate the reasonableness of management's calculation, and we were able to determine that the IBNR that is recorded within the financial statements is reasonable in relation to the financial statements taken as a whole. I will pause there. That is the majority of our presentation and highlights. Are there any questions for us?
No.
Great. Okay.
Okay. Anything else that you or Eric would like to share?
No, just once again, thank you to the entire team for helping us get to the point that we're at, and we're looking forward to March 31st.
Thank you to both of you.
Great, thank you.
Thank you.
Okay. Okay, so we'll turn over to Metro Plus presentation. Lauren? Hi, everyone.
Okay, so as we just concluded our year-end audit of our financials, we are now going to take a turn at just a one-click down level into our 2025 P&L performance. It was a strong performance year over year. We have favorable prior period adjustments that are, you can see that the blue boxes on the left side represent your the orange boxes represent the prior year aggregate write-ins. What a prior period aggregate write-in is, just for the board, is information that has come through after the close of the period. So for anything for 2024 and prior that was unknown at the time of close, it would be reflected in those boxes. It is significant this year because of the pass-throughs that have been taken on by the organization for directed payments from New York State, including UPL, ACR. There was also a release of IBNR that was due to just unknowns at the time of the 2024. So we do err on a more conservative error as stat does require. And then we also had a $40 million penalty release for an EIS to MCOR reconciliation. So bringing you back to the current year, which is the blue boxes, we also had a strong performance here year over year. There was revenue on the Medicaid line that had come through after a number of years where the rates have been at the bottom of the range. New York State can no longer substantiate that value. So we saw an increase of about 7% of our revenue come through on the Medicaid line of business. We also saw a 13% growth in our MetroPlus Gold line of business, which considerable contribution to the revenue and book of business for MetroPlus. Essential Plan continues to be a leader in our P&L across the board. Strong line of business, over 180,000 lives within that product offering. Next one. So this just gives you the perspective on where we thought we would be versus where we landed. And large in part, it is where we have expected on the whole. So we did close the year with 690,000 lives. There was an overall expectation where the revenue for the forecast was just at about $539 PMPM. As you can see, that landed slightly higher, and that is due into the fact that we received additional Medicaid revenues that were unplanned at the time. We also have our value-based payment arrangements with our two partners and ourselves. And that, due to the increased revenue and increased growth in lives, is the driver to the impact of that variance. Small savings in administrative expenses. Net income is as expected, a small change there. You'll note that the state directed payment value is slightly higher. It was just unknown at the time that we put the forecast together what the state was going to actually be approving for pass-through programs and MCO tax. So that is the deviation there. After operating income, we take back into consideration those items I went through on the pass-through and yielding us the $34.69 PM. Just a little bit more perspective. MetroPlus's organization this year yielded $5.3 billion of revenue with an MLR of 90.9%. We are an efficient organization running a lean ALR of about 7.3%. On the administrative side, I did note that there was some favorability. There was a total favorability of 6.6% to budget. $14.2 million was in the personal services and 12.1 driven by the OTPS vendor third-party agreements. The PS favorability, due to just the unknowns of the changes coming down the pipeline from the federal government, we took into consideration reductions where we could in non-essential vacancies. And then on the OTPS side, we do have some favorability that was just really delayed timing on certain initiatives we do have with H&H. And then, you know, small dollars that add up for printing and postage charges.
Good afternoon, everyone. Raven Solon. Just going to give a couple of updates on impactful regulatory changes that we are facing. So the first is on the MCO tax. And so just to give the board a refresher, this was something that sounded bad, but was actually good. Normally people don't like taxes, but this was a tool that New York State got permission from the federal government to utilize to ultimately have money flowing into the managed care and healthcare system and to managed care plans in New York State. Unfortunately, the federal government has rescinded New York's authority to use the tax in this way. And so the tax will be ending at the end of 2026. We thought that it was actually originally going to be ending right now, so right at the end of Q1, and so the extension to the end of the year was actually quite good news. So in total, we'll end up with a little bit more than a year's worth of that money flow to plans, which is, you know, ultimately the goal that we were trying to achieve in New York State with utilizing this tax.
Just to be clear, it's flowing to the plans, and the plans are floating this money to the providers.
Right.
So this is not funding for the plans, it's a funding for the health systems.
It's a pass-through.
Right.
Yep. And so, you know, we'll continue to utilize that for as long as New York State has allowance to do so. If you could go to the next slide, please. We also wanted to talk to the board about a rule, which is called the CMS Interoperability and Prior Authorization Rule. This is, well, it's the implementation that doesn't end. They have been iterating on this rule and the other requirements for health plans and providers for about 4 years now. And we have just recently received some very significant guidance. But one of the things I wanted to point out to the state as it relates to issuance of rules by CMS is the distinction between how these rules play out for managed care plans like MetroPlus, depending on the line of business or area that the rule is covering. So as you can see, when CMS issues a rule that impacts Medicare or that is around HIPAA, that rule comes essentially directly from the federal government to the managed care plan. So if CMS says, as they did under interoperability, you have to publish a patient access API where they are going to be able to see the information about their care, download that information into a third-party app to help them manage it. The specific language of the rule, the CFR, and the guidance and the deadlines for Medicare are directly applicable. For the lines of business that are managed by the state, in this for Metro Plus, that is Medicaid, Child Health Plus, and all of the ACA covered products on the marketplace, QHP, Essential Plan, that flows from CMS to the state to the managed care plan. And so with regard to the specific framework of the interoperability and prior authorization rule, New York State issued its guidance on this rule in early March, and it affects the lines of business that you see listed on the screen. And if you wanted to go to the next slide, and what it lays out is the new obligations for plans. And so we have to update and modify the timeframes for issuing prior authorization. These rules apply as they are working within the framework of the line of business that is affected. And so standard frameworks, concurrent review, which means the services are already happening and we need to do another review to continue the services, and then a special carve out for post-inpatient hospitalization activities. This essentially cuts the time frame that plans had to operate on under in half. So we went from having 14 days to receive the information, review the information, evaluate it, follow up, engage, and make our decision. And now we have 7 calendar days to make that decision. And in the instance of a standard review, no more than 3 business days after all the information is provided. The big thing here is that for the directly managed CMS lines of business, there is a 1/1/27 effective date. And New York indicated when its guidance was issued in the second week of March that health plans in New York State would need to come into compliance with this rule by April 1st. And so we are
April 1st of this year?
Yes, April 1st.
Next week.
Yes, 5 days from now, correct.
So finally, are the state timeframes and CMS's timeframes aligned? Because it might be worth it if that's the case.
So in that instance, it gets a lot more complicated. It does depend. So on the standard side, yes, the alignment of moving from 14 to 7 and all of that is very consistent. The distinction is CMS does not make a concurrent review distinction in its regulations, whereas New York State does for the government lines of business. And so there are unique scenarios where we have to determine which ones we're going to utilize and when, because CMS doesn't have specific regulations around that setup. But it's really more about when the rule flows from CMS to the state has to determine what it's going to take for them to be in compliance by the compliance deadline laid out in the federal regulation. And in this instance, New York determined that because of the way they operate and their timelines, for them to meet 1/1/27 compliance, plans had to meet April 2026 compliance. And so there will be a webinar with the state on March 31st for them to walk us through this process further. But it's really, the utilization timeframes our business teams have been working on and ready for. We've been aware of this. It's really the bullets on the bottom half of the slide that are of concern. We have to add a lot of very specific data elements regarding prior authorization requests and timeframes to our patient access API, which again is that data tool that individuals can pull their information down from to add to third-party apps or whatever they want to utilize. It is a very significant technological lift to accomplish that across your systems. And then we also have to create educational materials, post them, simplify them, a lot of other options around privacy and security resources for our members. The entirety of the interoperability and prior authorization rule really does focus on patient and member access to information, how they get the information that it's, been determined would be the most helpful for them in making their medical decisions and understanding what their impacts are.
Do you have to amend provider contracts too?
At this point, these specific components, we have not identified that we need to do that as part of this process, because our contracts are designed to say we meet the regulatory timeframes for these operations. And if a provider already had a shorter timeline, then that we would still have been bound by that. But we keep them at the regulatory level usually. I can't obviously speak to every single document. Next
What are
slide
the
as well.
penalties for not achieving this by April 1st?
So that is an extremely complicated question. We are not sure what the state's stance on compliance enforcement from this will be. And when it comes to rules that they are very focused on their relationship to CMS with, it often becomes very dependent on, is CMS taking a stance? How are they approaching the states? What are their options? We will, usually if they are engaging in compliance enforcement, they would conduct a review, issue a statement of deficiency or a statement of finding, depending on the nature of what they observed. Plans would be given an opportunity and time to bring themselves into compliance and engage in a plan of correction. State usually does not upfront issue penalties for these kinds of things, but every issuance of an SOD for factors of noncompliance can affect quality dollars and other activities. So again, it depends on the line of business and how the state approaches their enforcement.
What it doesn't do, and providers always push for, is that if they didn't meet the time frame for approving an authorization, it was automatically approved. Doesn't work that way.
Yeah.
So there's really no real benefit to the provider or the patient for this, except that in general, it should force these decisions to be made more quickly.
And we, especially on the API side, on the technology, we also have the obligation to report on the utilization of those tools. And again, some of these tools are live, but it's new data elements, new requirements, new expectations. I mean, in a recent report that we submitted to the state this week, we reported two individuals out of our 600,000 plus population that utilized the API.
Okay,
So again, like on the CMS side, for example, they would take that into account if they were assessing noncompliance, because what's the member impact? Was there actual negativity that could have resulted? And so something to say, only 2 people across our entire plan even attempted to utilize the data tool, it reduces that impact risk for noncompliance.
So has the state modified their standard notices that they give them to you guys?
Is the public even aware that they can use this access, right, in its previous iterations? I mean, part of it is people are just not aware that this is available, and part of it is it really is designed to change the healthcare system's behaviors, right? When you go to a new doctor, they restart. You were just born right now, and we're gonna do a full battery of evaluations. And obviously that's very wasteful. So the concept is right? The concept is you have a history. Let's allow your doctor and you have access to that history. The problem is this is not how the system is accustomed to function. And there's no awareness that this is happening in the public. So it is no surprise that, we have 2 attempts of using it.
Right. And if you can go one more slide down, Angela, that's just, I think that was it. We combined it. But yeah, so this is the type of implementations, large scale, that run across the entire company that we'll often share with the board as they significantly impact our operations and our membership. Any more questions? We can go on to I will turn it over to Tomas.
Thank you, Raven. Good, everyone. Good afternoon, everyone. My name is Tomas, and I'm pleased to provide you with an update about Project Edge. For those new to the boardroom, I want to introduce Project Edge. Project Edge is our technology-enabled business transformation. We want to give our team members access to best-in-class tools to effectively serve our members and providers. That is the whole concept of our transformation journey, to enable our team to serve our customers better. This slide comes from an original presentation we made back in 23 when we undertook this journey. We realized that our existing systems, while they've served us well, did not position us for the level of automation, excellence, and agility that we needed in the future. We undertook the journey and we accomplished and achieved our first major milestone. We went live in December for our first population, our HIV SNP population. I'm a numbers guy, I'm an engineer, and I'd love to share numbers with you. But instead of talking about numbers today, I want to talk about the impact that this has had on our team members. I just want to give you some examples. In our enrollment team, when we receive demographic updates from the state, we run through a process where we compare using tools, what we receive from the state and what exists in our system, and we manually key all the deltas and demographics, address changes, phone numbers, etc. Using this new system and this tool, that whole process is automated. The system performs the updates and creates an audit report for our team members to review. And when you think about the number of members we serve and the number of demographic updates we get, the opportunity is quite substantial of what we've been able to accomplish. When we think about our claims teams talk about the automation of scenarios, which in the past required multiple touches from multiple teams. You're thinking about scenarios like coordination of benefits or working with restricted recipients. Use cases we're able to automate now that in the past required touches from multiple teams. Our configuration teams and more technical team members, they tout the efficiency of the platform and the ability to reuse components that they've built. The emergency room benefit for the SNP population looks very similar to the emergency room benefit for the Medicaid population. And rather than creating a net new benefit from scratch, they're able to use the components to perform their activities much faster and reduce the risk of potential issues and defects down the line. And the area where we've had the biggest impact is our medical management teams. Our medical management teams are now working in one system between care management activities and activities, which means that their whole workflow is streamlined. When a member is admitted to the hospital, for example, for an inpatient stay, our system automatically creates activities and prompts for the next set of team members who are going to take action, be it our care managers or be it our discharge planning resources. Every activity is set up and communication is automatic. We no longer have an opportunity to forget to create an activity and assign it to someone to take the next step. And it's going to improve the outcomes of members. If we go to the next slide, I want to talk about the roadmap of what's next. I think we've talked about the fact that we went live in December for our first population, and we've successfully stabilized. We have been able to stabilize without significant disruption to our members and providers. And that is perhaps the biggest accomplishment of our go live. What's next for us is scaling it 100-fold. We've implemented it for our SNP population. Our next go live in August is for our Medicaid and HARP membership. We are really going to push volume through the system. We're also working on moving our outsourced lines of business, our Medicare and QHP books of business, to a partner that we selected that's going to implement and run those books of business for us. Lastly, I want to highlight is that we've moved our final go live, we've called it Wave 3, which looks at our CHIP, EP, and Gold Care populations to 27. We did that because we want to ensure quality through the process. And we found that our teams that we had working on this program needed more time. They needed more bandwidth and capacity to focus on getting the current waves done with the dedication and focus that they require. So we've made a conscious decision to extend Wave 3 into 2027. If we can go to the next slide, please. Again, I talked about the changes of how roadmap involved. The big change is that we've moved our final go live to 27 to ensure that we're able to meet the service and quality requirements that we have put on ourselves. You want to go to the next slide one more time, please. I want to talk about very briefly, how our implementations are progressing. I think we talked about Wave 2, our Medicaid and HARP go live plan for August. We are just starting our first rounds of testing next week, first rounds of configuration testing next week. And while we're optimistic that we will have a high quality product out of the gate, until we see the results of those testing efforts, we are holding off on jumping in joy and celebrating. The Medicaid benefit is very closely related to the SNP benefit, as well as the HARP benefit. Therefore, we do not expect the same volume of issues that we had in wave one. But again, we're holding off on celebrating until we see the test results confirm that hypothesis. This is why we see it marked as risk. We've given ourselves 4 or 5 months to test this in and out. Should we have time to recover? Should we find issues? But at the same time, until we see test results, we're all anxious to see what we will find and what our path to our go live will look like. If we jump to the next slide real quick, I'll just say a few sentences about our BPAS implementation. As you may have heard, we've began to execute on our MA and QHP implementation. We just signed the contract in early February. And ever since early February, we see a high level of risk in implementing what we have ahead of us. There is significant complexity in both the Medicare and QHP books of business, and they're not alike to what we've implemented so far. So the lift is substantial. The amount of time that we have is relatively low. So we took proactive action to ensure that we have both a plan A and a plan B for this implementation, both from a timing perspective and how we go about it. So our original plan, which is what we're talking about here, has us on the path to a go live 1/1. That plan has a high risk. We are continuing to execute and track against it, but it is a high risk, aggressive plan. We have plan Bs, we have contingencies, we have options we can incur should we choose to. But our plan that we've set out carries a substantial amount of risk, us being to achieve that 1/1 timeline. We will achieve the outcomes that we set out to do, but the time frame is the item that we're calling out the risk around. And that's the key update around our MA and QHP BPAS implementation. If you go to the last slide, just a few items for your awareness. One is we've gone through a transition in how we manage the program. We've insourced a lot of the PMO type of capabilities. We've done that and we are successfully running, but anytime you go through a transition like this, you run the risk of knowledge lost in the transition. We're managing it. We have good, strong documentation that we're continuing to work on improving even further. But we've changed the team supporting us. Lastly, again, we're eagerly awaiting the results of our testing efforts to tell us where we stand from a quality perspective on wave 2. Any questions around Project Edge?
I do have a question, but I suspect, are we talking afterwards? Maybe it's because I'm new. And the main question I was just trying to understand is what will the world look like once you've successfully transitioned all of the populations? What's the big measurable change? And maybe that's something I take offline. I hear right now the biggest challenge is getting everybody under it, but what KPIs will you see once it's done versus what existed before?
Thank you for the question. You've asked an excellent question. And the world would look different in 3 ways. First and foremost, our time to implement any change, any mandate, any regulatory change, any contract, any benefit will go from months to weeks. It will genuinely take us a fraction of the time to respond to a need for the organization, be it from a regulator or from our agreement with another party. 2 is from an operational perspective, the number of activities done using manual, I don't want to call it manual labor, but manual processes today is substantial. We're relying on 30-year-old technology. That's when the hands-free telephone in your home was an innovation. Technology has gone a long way in 30 years, and we're able to take advantage of some of that technology to really automate a lot of our workflows and processes and make them seamless. The third and probably the most important thing that you'll see is from a customer satisfaction perspective. Using automation allows us to reduce the incidence of errors. Using automation enables us to pay our providers faster and more accurately. It allows us to have more information at the fingertips and service our members faster. So it's, in my mind, if I were to narrow it down to 3 metrics: time to implement, my automation, operational efficiency, and the quality of service I'm able to provide to my members and providers.
And you have metrics, numbers attached to each of those, especially the last two?
We do just about in every department. I can talk about
Great.
claims auto adjudication or the number of enrollment transactions touched by hand. We've done it department by department. We define success and how we plan to use these tools.
Great.
Thank you for the question. I love number questions. I'm going to hand it off to Lila. Thank you.
All right, good afternoon, everybody. I'm here to talk about retention. It's a very centered focus of the organization right now. Comparing how we did in 2024 versus 2025 recertification results specifically. Just to ground you, 2024 is the blue line and 2025 is the yellow line. Starting in May and June of 2025, we started to run into specific headwinds where our recertification rate is not where we need it to be. Our goal is to hit 80%. The stretch goal is to hit 85%. In May, June timeframe, this is when the PAG unwind was officially over, and HRA was no longer auto-renewing members that were failing to recertify on time. And so what we did see was that there was a drop with our recertification rate because a lot of those members that were auto-renewed previously, we had to outreach to, and we had difficult time outreaching because the demographic information was outdated. Even though we were plugged into many ancillary vendors, pharmacy, dental, Epic, to get the demographic information, we still struggled to get information to successfully recertify. And it also turned out that many of those individuals no longer qualified for Medicaid as well, so they did disenroll. In addition, we also saw headwinds with the political climate where members who were specifically in our EP3 and EP4 line were hesitant to submit their documentation on time. And so we did struggle to get those members to renew. And lastly, another lever that we were looking at was staff productivity and making sure that they were recertifying as many as they could from both the sales and customer success side. So we are strengthening our monitoring of the staff. In the last quarter of 2025, we did place a quota mandate for the customer success team, whose specific responsibility is overall retention. We are monitoring that. We're hoping that we see an uptick, which we will, starting in 2026. So we know the importance of retention, specifically before the big changes that are about to happen as it relates to HR1 in 2027. So there are a lot of initiatives that we are putting into play in 2026, which I'll go over to in the future slide.
In fact, we saw retention is done both by customer success and sales because of the dashboard attachment. So we already saw that once sales started paying more attention, not just to selling, but also to retaining, the number started going up. So we immediately saw Roger's intervention reflected. And we want to see the same thing in customer success.
Yep. So next slide. So recertification, retention is not only just recertification, but it's also disenrollment from both a voluntary and involuntary disenrollment. Involuntary, there are different reasons why a member would involuntary disenroll outside of recertification. That could be failure to pay the premium. It could be invalid address. It could be other reasons. And so in 2025, we really focused on mitigating involuntary disenrollments. What were the quick wins? And so premium payment, invalid address, missing documentation, these were the areas that the team focused on. And because of that, we were able to mitigate a 0.5% less disenrollments from happening in 2025 in comparison to 2024. And then in addition to that, in August of 2024, the disenrollment mitigation strategy that the team used was outbound calls. And so what we did was to get more of a blanket, broader net of members that were disenrolling. We sent out a text message to members who were up for disenrollment. And through that, we were able to identify members that did not even realize that they were disenrolling. And so we were able to reach out to them to educate them as to why they were disenrolling. It could be the member had COB that was inaccurate. And so that was another tool for us to mitigate disenrollments from happening. mitigating disenrollments from both an involuntary and voluntary is still front and center in 2026 as well, because it's all part of retention. Next slide. So our retention initiatives that we are putting together in 2026, we had 3 solid years of data since the PHE unwind occurred in 2023. It's now 2026. We're going to be leveraging that data and partnering with a vendor to do predictive analysis and consumer segmentation to better hone in on our strategies and categorizing members better to focus on for recertification. So who are the members that will most likely recertify on their own? And who are the members that would be the more needier individuals that need more hand-holding to get them to recertify? So those are the different strategies that we are looking into. In addition to that, we are going to be looking at data from a pharmacy, claims, grievance, CAPS, to identify profiles of our members that may be at high risk to disenroll, whether that's a voluntary disenrollment or involuntary disenrollment. So we'll be leveraging that data to prevent disenrollments from happening. And then lastly, we're looking at EP5 members. EP5 will be eliminated coming July 1st. So we want to try to ensure that as many of our members who are in EP5, if they qualify for another product line within our book of business, that we would transition them into that product line to ensure continuity of care for those members. So we're trying to identify who those members are and work with them and to move them into a product line that they may qualify for. We will be increasing our community presence across all 5 boroughs, where we'll be looking at hotspots where we saw lower recertification rates. We're going to be partnering with our navigators and CBOs. We're going to be partnering with our providers to ensure that we reach all of our members that need to recertify and hopefully get them to recertify on time. We are also piloting an in-person home visit. We saw that this was something that worked. And so we are going to be looking at, based on predictive analysis that we are leveraging, those individuals that are the needier, more homebound individuals that would need us to come in and help them to recertify, get the documents and submit them for them. And so we were looking forward to seeing this boost our recertification rate as well. And so, and then the provider partnership that I mentioned here. Next slide. So in addition to what we're putting out in 2026 to increase our recertification rate, we are preparing for HR1, and we want to focus our resources judicially and smartly and effectively and efficiently. And so what we are doing is bringing more streamlining and automation into the customer success team. We're going to be doing customized disenrollment text messaging. We are going to encourage our members who are up for disenrollment to call us. If they call us through inbound calls, more of a success rate that we will be able to save them from disenrolling, as opposed to us outreaching to them and leaving voice messages. So those are the customizations that we are doing in 2026, as well as implementing IVR calls. So it's more systemic outbound calls to our members, encourage them to calling us. And then finally, we are working on a communication plan and a strategy to educate our members of their more frequent need of recertification, going from annual to biannual, the work requirements to the impacted membership. And so these are the different strategies that we are putting into play for 2026.
Well, and exploring AI, we know that both the health systems and other plans are exploring AI, bi-directional real-time communication. So because whatever improvements and efficiencies we'll put into place, this doubling the effort around research, I mean, it's massive. It is massive. So while all of this is important and needed, it's just not going to be enough. Yeah. So as you can imagine, there are companies that are popping up right now preparing for this requirement. And so we're exploring whether what they are pitching to us has true yield that we can trust.
Beyond everything else that you're doing.
Beyond, yes, because again, this is nice and important, and we will do it. Our assessment is that it's not going to be enough.
At any given time, our staff is working on 3 months cohorts, right? So we would have members who are coming up for recertification, individuals that are in the recertification window, and the individuals that are in the extension part. So right now, it's one cohort, January, February, March. When we go forward in 2027, it's going to be double that. It's going to be this cycle of recertification of members because we have to touch them twice.
Right, and the time frame are gonna be shorter.
Correct.
We're gonna
So
go to
it's
60
going to be
days.
pretty intensive. Okay. So the call center results. So Angela, I'll continue with the call center results. So we have the call center results here on the member
Just
side.
really briefly,
Yeah.
we need to
Okay.
wrap up the presentations in 2 minutes.
Okay.
So we have enough time for resolutions.
All right, I'll wrap it up really quick. So on the member call center, we continue to see a decline in the volume of calls coming in, and that is through operational efficiencies and automation, as well as a slight decline in the membership. So if you go to the next slide, the green is what we opened up 2026 with. The abandonment rate on the member side, we had pretty much stabilized under 5% in 2025. It's the purple line, and we opened up the year lower than what we opened up the year in prior years, 6.9%. There were some blips in some processes, but we were able to address it. Next slide. On the provider side, we did see a surge in the provider call volume in 2026, and this had to do with some of the migration issues that we had, as well as some system issues and configuration issues that we ran into, but we were able to internally address that and put some fixes in place. Next slide. And then in terms of the provider abandonment rate, our goal is to hit a less than 10% abandonment rate. We did a really nice job and held steady in 2025. We opened up the year in January of 2026, slightly higher than 2025, and that has to do with the migration between the migration of the legacy system to the new system, as well as some of the system configurations that we put into play in the last quarter that drove up a spike in the calls. And we're anticipating some bleed over into February, March, but then we're anticipating to get our hands around the provider abandonment rate. And that's it. Oh, the quality score. So our NPS scores continues to be high. It's higher than industry standard. In January, we were at a 61 NPS score. And our employee satisfaction is also at 4.66. And so we continue to really focus on our member experience, looking over at quality, reinforcing call collaboration, accuracy, first call resolution. And so I think that, our employees are happy, and therefore I think that carries over to our members. And so we're very happy about that. Next slide.
Okay, so I'm Mr. Mehdi, Deputy Chief Operating Officer. Member rewards, very briefly, most of our members are eligible for member rewards. You can see here some of the activities that make them eligible for member rewards. Some of them are standard medical activities, and others are walking steps, sunscreen use. So we're trying to change it up a bit to encourage good habits. The key thing to take away here is that really that we've paid out over the last 2 years, $5 million to our members, and that is cash that they can use at participating stores and online retailers. And we are using the Incom Convey vendor. All right, go to the next. This is sort of how it works. It's pretty standard rewards. You earn them. The balance comes on your card. I think the key thing here is just that we have we either the eligible activities are recorded through claims activity, or we have the member go and self-attest. One of these two things. The advantage is that the member never has to submit any paperwork themselves. They never have to get any approval, nothing. They do the activity, they get it either by self-attesting or through claims activity. They can redeem it at thousands of stores and then online, and Amazon was added this year. So yeah, and then we handle all the member queries. Our own MetroPlus call center handles it, so they don't have to go to another entity. And then for the last slide, I'll just quickly add to the goal member rewards. Of course, the goal member goal plan available to all New York City employees. We have a plan. We start in September 2025. Right now, just for subscribers, we will expand that beyond subscribers, hopefully. This is an example of self-attestation. You just go, you say you completed the activity, you check the box, and you click submit. You can see the rewards there, very common things that we all do. You can get rewarded for that. That's really member rewards.
Thank you. Okay, so that completes the presentation portion, and we're gonna move on to resolutions.
Meeting minutes.
Oh, motion to approve last board minutes. Second, all in favor?
Aye.
Aye.
Motion carries. Okay. So we had a discussion, for times that Sally's not able to be here, like right now, a good demonstration, that we really needed to have a vice chairperson for the board of directors. So this is the resolution appointing Fred Covino as the vice chairperson of the board of directors. Except for Juliana, the other board members are familiar with Fred and his background. So I'm just gonna ask for a motion to approve Fred as the vice chairperson.
Second.
All in favor?
Aye.
Aye. Motion carries. Next.
And Fred now gets to run the meeting.
And if there-
Vice Chair, here you go, Fred.
All yours.
The bylaws are set up so that the meetings are run by the chair. If the chair is not here, by the vice chair is not here, by the CEO.
Okay, so a resolution authorizing the executive director of MetroPlusHealth Plan, Inc. to execute contracts with 4 law firms to provide legal services and on an as-needed basis for MetroPlus. The firms are Greenberg Traurig, Hinnom Straub, Tremont LLP, and Tater, Krinsky, and Drogan LLP. The contract shall be for a term of 3 years with 2 options to renew for 1 year each, solely exercisable by MetroPlus for a cumulative amount not to exceed $2.5 million for a total 5-year contract period. So with that, I'll turn it over to Stephen.
Great. Thanks, Fred. You can go to the next slide. So we're seeking new firms to provide legal services for MetroPlus. Our current contracts expire in about 3 days at the end of the month, 5 days at the end of the month. We did a full RFP that was issued in September. 4 law firms are being selected. Greenberg Traurig, who is our current day-to-day regulatory counsel, and they will, spoiler alert, they will remain the day-to-day counsel. But also Hinman Straub, Cher Tremonte, Carter Krinsky, and Drogan. We're seeking an authority for $2.5 million over the 5 years across all 4 contracts. For point of history, in 2021, we received authority for $2 million. Our spend over that 5-year period has been approximately $1.65 million. The total amount is an authorization. It's not a goal for us. We use outside counsel as is appropriate, as we feel need to. And the increase is essentially all due to increases in rates. We had rates set in 2021. 5 years later, legal services rates have increased to account for that. And yesterday, the Finance Committee approved the resolution. Next slide. So the scope of work is essentially anything and everything that could come across our desks. H&H Legal does some things for us, like labor relations and EEO, things like that. But anything that we don't do in-house, that H&H Legal doesn't do, or that we don't use the New York State Law Department for, we use outside counsel for. That's predominantly going to be counseling on statutory and regulatory requirements, compliance issues, provider contracting, some negotiations with providers, a bit like that. But it also could include litigation related to False Claims Act. Hopefully we haven't had one, hopefully we won't, but you never know. Or other types of litigation including, for example, the one that we're currently doing where we're suing the state, but also for privacy and security various issues. As I mentioned, Greenberg Traurig will remain our day-to-day counsel. The others, we're not guaranteeing work to anybody. We will give out work as it's appropriate and as their specialties or their expertise sort of fits it. The four firms sort of fit into two of the firms are specializing in compliance and regulatory, and two of the firms are really litigation firms.
Litigation firms? Those are
Litigation
the last
firms.
two.
The last two, Sher
That's
Tremonti
what I was wondering
and
about.
Tartar Krinsky are really litigation firms. I mean, they have some counseling, but they don't really, well, one of them actually, Sher Tremonti doesn't do counseling at all. They really just do litigation. And Tartar Krinsky specializes in the litigation aspect. So they're more likely when we need them to do that. Hinman Traub is really there. They're used by about half the plants in the state. Greenberg Traurig is used by the other half, give or take. They're there in case there's a conflict with Greenberg Traurig, or we want sort of a second look or a different perspective, because I do have a slightly different perspectives. So next slide. We did relatively standard criteria looking for law firms. We wanted the firms to be at least 25 attorneys because we wanted to have them be able to have enough size and enough expertise that they could provide a wide range of services. We wanted 5 years experience with New York managed care. We did experience at 65% and cost at 35%. And we ended up picking 4 of the 5 firms that submitted. Oh, here we go. We sent the proposal to 9 firms. We advertised in the city record. We received 5 proposals. We did interviews and we selected 4, the top 4. Oh, and the evaluation committee consisted of MetroPlus Legal, MetroPlus Compliance and Regulatory, and also H&H Legal. And so we're here, 3-year contract, 2 one-year options to renew. It will start April 1st, and total contract authority is $2.5 million. I'll note that we did not set MWB goals for these contracts, which is the same thing that H&H Legal did when they solicited firms last year for their counsel. Generally speaking, you don't want your law firm subcontracting. You're hiring them for them to do the work themselves.
Okay, if nobody has any additional questions, I'd ask for a motion to approve.
So moved.
Second?
Second.
All in favor, aye?
Aye.
Okay, so the motion's approved. The next resolution, authorizing the Executive Director of MetroPlusHealth Plan, Inc. to execute a contract with Health Management Systems, Inc. for third-party health insurance identification and recovery services for an amount not to exceed $15 million for a total 5-year contract period.
Hi, everyone. So MetroPlus is seeking a best interest contract with Health Management System, HMS, for third-party health insurance identification and recovery services. MetroPlus requires these services in order to maximize our cost savings through cost avoidance with proactive identification of undisclosed coverage prior to a claims payment. The services are currently provided across all of our lines of business, or most of our lines of business. What we are adding with this best interest contract is to extend the services to our essential plan line of business. Our ask is authorization to execute a best interest contract with HMS in the amount of $15 million for a 5-year contract period. HMS is our current third-party insurance vendor. We procured for TPI services in 2010, and do you mind going to the next slide? Great. In 2010, 2015, and in 2020, and HMS was selected each time. They are a national vendor for these services, and they are one of New York State Department of Health's TPI service vendors. They have provided us with solid outcomes in this service space. But the reason that we are continuing with this incumbent vendor and didn't issue a formal RFP process is 2 primary considerations. First being that they provided us pricing reductions with going with continuing with their services. And they've also are going to enable us to secure the pricing for future years by executing a multi-year agreement. Additionally, throughout our duration of our relationship with the vendor, they haven't implemented price increases, and we have a long-term pricing stability and continued value with them. The second consideration was that as we are currently undergoing Project Edge implementation, there's been a lot of testing and configuration of HMS files within HRP. We completed those for wave 1 and are currently working on configuration efforts for the additional go lives and implementation waves. So the decision to remain with them and process the best interest it is advantageous to us at this time. If we go to the next slide, you could see that we have the overall savings that they're proposing to us with extension is a 10% reduction compared to our current rates with them across all the LOBs. They've also given us a pricing improvements and a reduction of 1.5% on our vendor recovery fee structure, along with some transaction fee reductions for record ads and for term records. So the board approval request is us seeking a 5-year best interest contract with annual options to renew. The anticipated contract start date would be May 1st, and the total authority for the 5 years is $15 million.
I just want to clarify, when you were speaking before, you said you were adding in the EP line. This 15 million is just not just to add the EP line. It's for the full contract.
For the full contract with additionally adding the EP line.
So the other question that I had is that with the audit that we had with OMIG and HMS's conflict or whatever that was, they don't appear to have been very helpful because of the inability to provide the background information that the state was using, right? So how did you deal with that with them?
So, to provide a little bit of context for the state uses and has used HMS to check this third-party insurance and to try to recoup monies from us when we were both collecting captive payments for Medicaid from them, while there was other private insurance that should have been used or some other government insurance that should have been used. And so we used HMS to help us do that on a day-to-day basis as we're sort of looking around to try to check these claims. And the state uses HMS at the same time to do their audits, and they're also doing this information. And the issue that we had during the audit, we have many issues, but one of the issues that we have during the audit is that HMS looks at when they're doing work for us, they look at a different file set than they do when they do work for the state. That there are records that they say the state lets them look at for the state's purposes and does not let them use for plans purposes. And that leads to conflicts in the sense that they're giving us advice and the state then comes back with a different set of advice. I've not thought of an answer to this problem. I mean, it's sort of maddening, and believe me, it's maddening because I don't know that I have a solution to it.
It's not their decision.
Right.
Correct.
It's the state's decision. So if they provide different information to us from what they're receiving, right?
Correct. So the state has databases, tools, et cetera, that they as a state agency have access to, including certain IRS databases, things of that nature. When HMS is contracted with a entity like MetroPlus or any other managed care plan, they cannot use 100% of those same resources.
But maybe they can, but they know the people that pop out of it, right? And so they're giving you a list with the names of people who are popping out at the state level, and it seems like they should be able to cross match that. So and not using the same form, I mean, the database, but at least say, oh, well, this, giving you an alert that this is on OMIG system because of whatever.
Well,
so part of the problem is
they cannot do that, right?
We have to do it.
Well, so the state part of the issue is that we're doing it in real time as we're checking. The state, for example, in our audit, the state was covering years 2019 through 2022 or 2023. They will come in years later. And so part of it is that they're using a database in a different time period with a different set of data than was available at the point in time. And so part of the difference between what we're able to find in 2020 in real time, there may be more information may have developed. They may have learned that other people had insurance and it gets added to the data later. But either way, they're coming in and looking at it in 2024 when they do the audit, or 2023. So it's not that they could have told us back then, hey, they're not looking at it at the same time, right? So it's not like they're looking at it here and here at the same time, and they're not only giving us part. They look at it for us here on their databases, and then 3 years later, they get the audit and they look at it, and they now tell us, hey, you should never have done that. At that point, it's too late for us.
I mean, they should have never done that, because, I mean,
Right.
Well,
they're
They
basically,
determine eligibility.
exactly.
Right,
Yes.
that's right.
That's my,
I mean, the whole thing is also, I mean,
that would be very
What
frustrating.
it's
percentage?
wildly frustrating because remember, the state's the one who gets to take people on and off eligibility. We can't do that. And so the idea that the state is telling us, oh, you have to look at this database and make your decisions. And we've got this other database that's more complete, and we're not going to look at it right now, and you don't get to look at it, but we're going to take
We're gonna
money
ding
back
you.
from you
Yeah,
later.
based on it.
Is the life of a plan sometimes.
I mean, we
but-
have it
absurd,
in
but-
writing. We literally have it in writing.
Yes.
We got it from the state. The state stating in writing, we have access to information
But you don't.
that you do not have and you will not have. And nevertheless, we're gonna ding you if you didn't get it right.
I heard you mention something else that might open a potential possibility. It sounds like it's not 100%, the discrepancies are not 100% due to this other database, that it's sometimes just information gets refreshed over time. Is that right? What percentage of the discrepancies are due to this, database that only the state may access, versus if you just go back a month later, 3 months later, 4 months later, there's new information? So that
Well,
I'm wondering if there's an opportunity for HMS.
So they do that on that timeline, but that becomes much more complicated when you're looking at the timelines that Steve mentioned. They're going back 5, 6, 7, 8, 9, sometimes 10 years. And so for us, we have
They being
individuals.
the state.
Yes, when they're auditing us, and so
Another arm of the
It's
state.
not 6.
correct.
They've expanded. They've expanded beyond 6 years, go back.
Well, they-
10, yeah.
Is it 10 now?
Mhm. Yes. And
You don't see them go back 10 very often.
Right.
I mean,
I mean,
they
have done it, but yes.
It's not the common, that's not the norm.
10 is the timeframe allowance that they have for these reviews now. But so the other matter is, as Steve said, when they came to audit us, in many of those instances, those individuals weren't our members anymore. And some of them hadn't been our members for years, but the state is saying in 2016, in 2019, in any of these back years, you collected a premium for that person in March of 2019 and you should not have. And so even if that individual hasn't been enrolled with MetroPlus since 2020, we wouldn't have then the capacity to be able to continually keep them in the books, although HMS does do a more rolling basis. But once you start getting into years, it becomes less effective than it would be on like the months, as you mentioned.
Yeah, the question is, I mean, you're not gonna be able to get to the 100% overlap for all the reasons, but is there a way to chip down this and improve overlap? So even if you can't do it for 10 years, is there some opportunity?
That's a really good suggestion. I think we should look into it. Kind of rerunning almost preemptively.
Right.
And seeing kind of what's potentially at risk.
If they're updating, like you
Right,
say, it seems
right.
like that would be.
So we can go back and look. I just want the committee to be clear. HMS is doing that. They do not do a one-time only check for an individual, because obviously things change over time. But we could potentially look at what's feasible for how many more months, how much longer we could do to chip away at that. But I didn't want the board thinking that they aren't doing perpetual reruns presently. They are, but we can see if there might be a way to do that for a longer stretch of time.
Many of the plans use them, right? So
Yes.
I mean, there's basically 2 firms out there that do this.
that's what I was gonna ask you, how many entities are out there?
I think there's
doing
only 2 that. do this meaningfully.
And the
Absolutely.
presentation didn't specifically note all of this, but right, it's not just for our financial interest. We fulfill our compliance obligations with this tool. We have to report on it. HMS's findings go in monthly to the Office of the Medicaid Inspector General. My team submits them every single month. So, we are fulfilling many sets of obligations and goals as an organization with this.
So in terms of outcomes, do you have any data on, for the $15 million that you'll be spending over the course of 3 years, what kind of returns you get from?
Yes, we can follow up and provide that.
Is it a secret?
Oh, I don't have it on hand. Yeah.
We just don't have it in front of us at the moment,
Yeah.
but we can pull it. Yeah.
All right, does anybody have any further questions or needs of information? If not, I'd ask that we consider this for approval. Ask for a motion to approve.
Do you want to pull the numbers first, or are you comfortable to move forward?
No, I'd like the information, but I'm comfortable with your recommendation.
Or do you want to turn your microphone on just so
sorry.
Fred can hear? Yeah.
Yeah, I'm comfortable with moving forward now.
We have a motion to approve. Second, please.
Second.
All in favor, aye.
Aye.
So we'll proceed with the resolution.
Good.
Next resolution authorizing the amendment of the best interest contract resolution approved by the MetroPlus Board of Directors on September 26, 2025 with SourceEdge Solutions LLC for data migration and conversion of professional services for an amount not to exceed $2.3 million, including contingency for an 18-month contract and authorization. The Executive Director of MetroPlus Health Plan, Inc., to reallocate the approved spending authority to execute a best interest contract with SourceEdge Solutions LLC for implementation of a solution for converting data testing in the amount of $2.3 million for 1 year term.
Good afternoon. I'll be presenting this. Ganesh Ramersan, CIO at MetroPlus. So SourceEdge is one of the vendors that we use as part of our Health Edge implementation. So they are responsible for a lot of the data conversion, taking information from our legacy claim system called PowerStep and our legacy system called CareConnect, bundling that all up and moving it with there's a mapping that they've done to map this data and get it into our HRP system and our guiding care system. We are transmitting about 3 years, a little over 3 years worth of data into these systems from our legacy system. But we are obligated to be able to go back and review data that is much older than 3 years. So upwards of 10 years of data needs to be reviewed periodically. And so the IT app dev department was extremely busy as part of this implementation and a bunch of other projects. So at the time when we got approval from the board, we decided to leverage this organization to help capture all of this old data, build out an interface so that the business unit can then go in and actually review anything that they need to from this separate read-only document. Since that time, we have leveraged some resources that were underutilized, and I jokingly say underutilized, meaning they're under 125, 150% because they're all at more than capacity. But we've found additional resources to help build out what we would need SourceEdge to do for us. So we no longer needed to engage SourceEdge to do that development. And so the app dev team has come up with a mechanism to capture this old data in a database, build out an interface that will save us the $2.3 million. One of the biggest challenges we've had with our Wave 1 implementation is around testing, and particularly data testing. So what we decided to do was let's reallocate this $2.3 million that was approved for SourceEdge to use to build this interface to instead build out a suite of testing programs that can help automate some of the data testing. And since they know our data much better than anybody at this moment, they would be able to develop these tools fairly efficiently. And so We built in, the 2.3 is inclusive of about a 400,000 contingency into their proposal to build out these suite of tools and do the data testing for us. So what we're asking of the board is not for a new authority, but to reallocate that authority for this new purpose. So that's pretty much the two slides in a nutshell. We can go to the third slide. And so again, to summarize, we are seeking to amend the previously approved authority and execute a one-year agreement with SourceEdge in the amount of 2.3 million for the data testing services.
Make a motion.
So does anybody, I'll open up for questions.
Fred, I made a motion to approve the request.
Okay. Any seconds?
Second.
All in favor? Aye. Resolution's approved. Next resolution, authorizing the Executive Director of MetroPlusHealth Plan, Inc. to increase the spending authority for the contract with SourceEdge Solutions, LLC to implement, integrate, and license an enterprise data hub solution in the amount of $720,000 for a new total not to exceed amount of $2,957,000 for the remaining contract term.
So I'll be presenting this one as well. So again, with SourceEdge, so our original go live date for wave one was April of 2025. Obviously, there was a lot of complications. There's a lot of data, a lot of moving parts. And so the implementation actually didn't get completed until December. And so the additional work that we've had them do, we've paid for. But we've also paid in SourceEdge for them to use a software called Datachrome that helps an efficient way to pull this data out, map it. And we will continue to use their Datachrome software beyond the go live dates of all of the waves. And so what we've decided to do, because we need additional funding for the resources that are actually doing the day-to-day work, is to pull the Datachrome component out of the original authority and leave that authority that we have for the additional work that they will be doing and use the 720 for the cost of the software. So in other words, it's a lot more work that they're doing. This was a way for us to increase the funding source for the continued work that they are doing for wave two. And this will bring us, this additional funding will bring us to the end of 2026.
Do you own the software after you
Licensed?
The license.
Yeah, we're licensing the software just like a Microsoft suite of products.
Right.
I will advise the board that we still have wave three going on into 2027. So this funding source will bring us up to the end of 2026, where we're being very judicious in how we use these resources so that we don't go over or won't come back to the board in 2026 to ask for additional funding for SourceEdge. But we will be coming back in 2027 based on the level of work for the wave three component for it.
Motion to approve? Motion.
All in favor?
Aye.
Aye. Okay. With that, Stephen, are we in need of going into executive session at this point?
We are.
Okay, so I'd like to bring us into an executive session.
Executive session, sound like a motion.
All in favor?
Those who have not been asked.
And then let's adjourn the meeting. Do we adjourn?
Yes. So with that said and executive session over, I will adjourn the meeting. Good luck, everyone. We'll see you soon.
Thank you, Fred.
Thank you, Fred.
Yeah.
I know.
Sorry,
yeah.
No problem, I know there's a order.
Okay.
Thank you.
Yep. I don't know what did she send me something?
Yes, they should have.
Oh, they sent me something.
They should have, yeah.
Okay.
Hello?
Oh, yeah, and then I'll give one to you. We're gonna, I think ELT outside. Okay. Oh, yeah, take care of that. Thank you. Safe travels. Quick travels for you.
Are you hiring a new marketing
Dep-
VP.
Deputy, yes, yes.
Cause
I love
the
back, maybe?
agency.
Yeah. I'm telling you, everybody has caught on to my meeting
Hire
pros
me
situation.
for
You
it.
didn't until you got a rollie, but then you were like,